Hi everyone, I'm Rick Bensignor. Today is Tuesday, November 22nd, and welcome to this week's In the Know Trader show. Well, we've got a holiday week, and what we're going to do today in our trader education portion is talk about, just for a couple minutes, what holiday time means, both for you as a trader, as well as how important it is that holiday time also represents step away from the market time. And then when we go through charts, this week I decided to go through my version of the updated FANG list, which includes now Apple, Amazon, Google, Meta, Microsoft, NVIDIA, Tesla, and Taiwan Semi. I think these are the 8 most important names in the large cap space that investors continuously focus on, and therefore this is kind of my new updated FANG list. So we'll go through those one by one. To remind you of the products that we have here at In the Know Trader, we have a weekly tactical ETF trader report. It comes out every Thursday night. It goes through the entire macro outlook of what's going on across the asset classes. So we do a deep dive into bonds, most especially the U.S. 10-year Treasury, credit spreads, the U.S. dollar, often gold, sometimes the oil market, and then a real deep dive into the S&P, such that you know what I'm thinking both shorter term and medium term in the marketplace, as well as specific levels to key off of and what my current strategy is. Plus, then I give you a brand new ETF idea each week, and I walk you through all the open trades that we have from prior weeks until we close out the trades. That's our Thursday weekly ETF Tactical Trader Report. You can sign up for that at inthenowtrader.com. We also have a second product that comes out monthly called the 7-Eleven Report. And that report, the goal is to beat the S&P's return by investing in no more than 7 of the 11 SPDR macro sector ETFs like XLE, XLK, XLF, etc. There are 11 of those XL sector SPDR ETFs. And our goal is to avoid the likely underperformers. And if we can do that by virtue of not being an underperformers, you will outperform the market. Now, certainly easier said than done. And this is what almost every active mutual fund manager tries to do who is benchmarked against the S&P, but obviously very few ever get to do it, because we know that statistically 6 out of 7 portfolio managers underperformed their benchmark. We are fortunate that we are well outperforming the benchmark. So as of October 31st, the last time we once a month, we calculate our returns of our recommendations and which ETFs we have you in versus the SPDR's return. We are outperforming the S&P this year by over 5%, more specifically 5.14%. We have outperformed 9 of the 10 months that have so far been in existence this year. And if you think that's just a bear market play that we were able to capture, let's go back to how we've statistically done since we started this report on August 1st, 2020. We are outperforming the S&P by 10.98%, virtually 11% in just over the 2 years that we started. So we not only outperformed in the up markets that existed from August 2020 until the end of 2021, but we've also outperformed in the down market that we've seen for the bulk of this year. So this is an excellent tool and report to subscribe to, especially if you are a money manager as a financial consultant, a general portfolio manager, and certainly if you're managing your own funds and you consistently put money in a passive index like SPDR's or Vanguard's VOO or any of the S&P type benchmark ETFs, we are doing way, way better by combining both what I believe is the best quantitative model on the street, along with my interpretation of the 11 sectors, with my 40 plus year career on the street. I combine them into allocating how much percent of each one of the 7 that we're going to choose from to go into. And obviously it's working. So you can subscribe to that also at inthenowtrader.com. And if you subscribe to both, you get a deep discount on them. And if you subscribe to both, especially for 1 year subscriptions where you sign up for the whole year instead of going month to month, you get a deep, deep discount. So check it out at inthenowtrader.com. You also can subscribe to my YouTube channel. Please go to youtube.com/inthenowtrader, click on the subscribe button, and also follow me on Twitter, and the handle is at inthenowtrader. There we go. So let's get down to our conversation that we're going to have this week about holiday time is also a step away from the market time. So what's that mean? Well, this week we kind of start the official holiday season in the United States with Thanksgiving on Thursday. And then, of course, about 5 weeks later, so you've got Christmas. And what I want to tell you is that when it's holiday time and when you get a day off and possibly even, and hopefully you Friday off also. Some people get it off, some people don't. But I'd say as somebody who's vastly invested in the markets like I am, to the sense that it is what I do the bulk of my days. I am watching the markets, writing about the markets, presenting webinars about the markets. You know, I live and breathe the markets. And not only just by chance is Thanksgiving my favorite holiday of the year, because notice how I said yield. That's how much I'm used to talking about markets. But it's also a time that forces me to step away from being and watching the market. Now, in this case, you're talking about a 24-hour period. But even on Fridays, I rarely work on the Friday after Thanksgiving, because what that allows me to do is it really creates a 4-day weekend for me. And it's not that I won't see where the market closes on Friday, but I'm not going to be sitting at my desk working all day and making sure I'm on top of everything that's going on. And I do that because the 4-day break gives me a chance to step back from the market, to clear my mind a little bit, to enjoy family time. And I happen to have a son who's at Ohio State. I have another son who is at Michigan. So every Thanksgiving is the Ohio State-Michigan game on Saturday. You can imagine what this house is like when we have those two together for this Major League football game each year. And I get tremendous enjoyment and satisfaction out of spending family time and getting my head out of market time. So I'm suggesting to you too, even if you have to work Friday and you can't get yourself the 4 days off, but you get the 1 and then the 2 days for the weekend, use the time that the markets are closed to really give yourself a break and not be so invested in everything that's going on in the market. You'll actually find that it very much can help clear your head. It gives you a chance to step back and reevaluate your opinions also, because often once we have an opinion, we tend to stick with it because we want to be right about what we're thinking. And I found over time that the time away from the market also gives you a chance to kind of rethink things and be open to even looking at the other side of the equation. If you're a bull and you're kind of a confirmed bull, maybe the time away gives you a chance to think about that and think about all the reasons why so many are bearish for 2023. On the flip side, if you're a confirmed bear, you can't help but see how the market's traded since the October low, which is the 2022 low, and how much it's come back, and the fact that you basically have a double bottom and that the market potentially has some more room to go on the upside. So it's not about talking yourself out of how you feel about the market, but also being open to looking at the fact that there's another side of the equation, and that, when it comes down to it, every time you execute a trade, in order to actually get filled on your trade, you need someone who is in total disagreement to what you're thinking. Because if you're a buyer, you only get filled because somebody's a seller at that same price. So if you're bullish and somebody's bearish, and they wouldn't sell if they weren't bearish, there's got to be a reason they're bearish. So don't close your mind off into thinking that the way you think about the market has to be correct, because clearly somebody's on the other side of that trade who disagrees. And there's a reason they disagree. So maybe they know something you don't. I'm not saying they're smarter or they have inside information or anything like that. Just understand that somebody is on the other side of every trade, disagreeing with what you're doing. So holiday time is a good time to kind of step back, reevaluate, spend quality time with friends and family, and get your head out of the market, at least for a short amount of time. And look, when you have real vacation time, you take a week off from vacation. There are some people who have really working vacations. Well, that's not real vacation. Real vacation is stepping back from what you do every day in your professional career to get a break from that. And it's a very healthy thing. And it is something that you should really make sure you find the time to do, because a working vacation, as anybody knows, you come home from that vacation and you feel like you never left. And that just kind of goes against the whole reason to be on vacation in the first place. So think about that as we head into holiday time. All right. Now, as far as the names I want to go over this week, I typically pick a sector or something in the market that I think is important to go for and look at. And this week I said, what have we not done in a while? And right away I was thinking, all right, well, FANG names. But to me, FANG names aren't really FANG names anymore. In fact, the F in FANG of Facebook is now an M for Meta. So we don't really even have FANG anymore. So I thought about what are the most important names that drive the market, the large cap names that really mean something, both in the sense of how the market is doing, but also how, collectively you get a sense of what these big large cap names are doing and how much sway they have in the indexes. So we're talking about Apple, Amazon, Google, Meta, Microsoft, NVIDIA, Tesla, and Taiwan Semi. Those are the names that we'll take a look at. So let's start. We're going to switch to our charts. And we start here with Apple. So we're going to stick with weekly charts just as a general kind of bigger picture type thing. And what we see are, here also this year, if I draw a horizontal line across where the first low was made in May, just before the June low, we see a level that basically captures the May low, the June low, the October low, and the November low. So clearly in just beneath 135, let's call it 133-ish, give or take, 135, somewhere in the mid 130s is what we've so far seen to be very important support. Where do we have the bulk of the resistance? Well, certainly up at the highs is a level, and then just beneath there, you also have the August high, multiple highs this year. So everything in between is kind of mishmash and just trading, and where it's relatively more difficult to really make money when you're trading the middle part. So we know that, in the mid 130s, it's been so far a buy this year. Anything north of, let's call it 170, has been a sale. So on top of that, now let's look a little more inside what the cloud charts are saying. So we even broke above the cloud on the August rally. So it seems to have less meaning. Then we broke beneath the cloud. And you can see that the cloud kind of gets narrow and is quite flat going forward, which generally indicates a sideways market. So I'm going to almost say that right now in this time frame, the cloud is not going to be terribly helpful. So I'm going to take it away, and now let's just take a look at propulsion levels that we're dealing with. So on the recent sell-off, we stopped at the bearish propulsion exhaustion level. That's the red triangles. We're currently above the bullish propulsion level, which if properly hurdled will turn from a horizontal dashed green line into triangles, which means the rules were met for this to then expect a thrust higher. And the thrust would target 157, almost 158, which we actually got to already a month ago. More kind of mishmash stuff, not really anything that is majorly helpful right now. So I'm going to tell you, I don't think there's a heck of a lot to really be able to do, although Apple is a great trading stock and certainly has great trading volume each day. Right now, we're kind of in the middle of the range. There's no particular vig to what's going on. And I'd say I don't have a huge opinion on it. So that's my takeaway, is if you want to trade more towards the extremes, you do. And right now, we still have resistance up at like 171 and change from this TDST line. That's the highest high in this 9 count going down. The other thing I want to say before we switch to Amazon is that we have gotten as far as an 11 towards a 13. So we still don't have a downside exhaustion signal to this. Also to fully offset the 13 that we essentially saw on the all-time highs. So I would expect more back and forth here without a decided move either way. All right, let's take a look at Amazon. Now, Amazon reported earnings a few weeks back. The stock sold down $20 as soon as the earnings report came out. And in the aftermarket, I know I bought this for myself pretty much right against this dotted line, which is a TDST line that goes back to early 2020. Just after the COVID low, we did a 9 up. That created the TDST line from the lowest low in the 9 count. And to me, this was a place I was happy taking a chance at Amazon. So I bought some Amazon for myself at 89, and I'm still holding it and not loving the fact that we're still here, kind of close by. We got to, you can see we got a little over $100, but it's come right back down. We're on a 5 towards a possible 9. That 9 count would end up being lower and could push even down towards 80. But in the general scheme of things, I don't like, so here, when I take a look back going several years, I don't mind taking a stab somewhere in here. Certainly there are trap buyers well above. And if we look at where this broke down from, you can see that when we had the 13 in the spring this year for the downside exhaustion, we came all the way back up to the same level that we broke down from. So this is acting very technically. There is some support down here all the way towards 80. I don't think it's a bad place to be in the name. But you know, it's still an expensive stock. It's not as expensive as it used to be. For right now, I'm holding, and but I can tell you, I don't love the fact that after this has bottomed, that we're still, you know, very close. We're only a couple % off of the bottom at this point. So I'll see how we, you know, move over the next few weeks, but I may not end up holding it. I'll have to see. But right now, we kind of know that just north of 140, we're going to have some pretty stiff resistance. And right now, some support here, 90-ish, and then again at 80, and possibly all the way down at 60 if this really breaks and does a whole nother leg down. And if it does that, then I can assume that Apple's probably down near 120 or lower, and that the S&P is probably down in the low 3000s if we get there. So it's one of the reasons this is an important name at looking at the market overall, is not just for the importance of Amazon, but also just as an indicator of how people are looking at the market going forward. And this is, one of the key names. All right, let's move on to Google. And I'm going to use the Class A shares, GOOGL. And you can see that about a month ago or so, we had a downside exhaustion 13 signal. We broke just a hint through, 1 week we break through the 200-week moving average, made the low for the year, and it's come back. I have no outright position in Google myself, but I also can look at where it's going to have trouble getting back above. And if you look at kind of where these lows were, somewhere in the 105 neighborhood, it's going to have a hard time getting back above. You can see about 5 weeks ago, we got to 104.82. So we got pretty darn close to it. Essentially, that was a successful, or I guess you could call it an unsuccessful test in the sense that it couldn't get above. Here's your downtrend line. So Google's going to have, trouble anywhere from 105 to probably about 110, 115 in the next couple of months. On the downside, if we make new lows, look for this to get towards probably 80 or lower. So same thing, right where we are now. Tough call of what to do. Your upside reward is kind of equal to your downside risk. If you bought it now and you stopped yourself out on a new Friday closing low for the year, you're not really ahead. In fact, you probably have to risk more than what you would expect on the upside now. So here and now, tough name to really do anything with. If I get a MACD, it looks like MACD is potentially just crossing over. And if you get enough strength to make a W pattern out of the MACD and you take out the middle, then you may get some further up move. And that would have to come with us also above the downtrend line. So, and maybe we'll see this as we go through all of the names. I'm not sure, but again, nothing that stands out right now is something that I definitely want to play. Here is Meta, the former Facebook. And I actually bought this for my own account at, I think it was the day that made the low this year. It was 88 and change that I paid. So the low is 88.09. I paid something in the 88 handle, I know. And I was pleased. Now, the 9 count helped me, but it was actually something that I had in place for quite some time. So even when Meta was trading 150, I had my bid in at just in the 88 handle, never thinking I was going to get it. But a lot of times, and I've done webinars for you on this, where if there's a level that you are content at buying at that's well beneath the market, I have no problem at putting in a GTC, a good till cancel order on that name. And if it ever gets down there, you're saying, regardless of the reason it goes down there, you're leaving a resting limit order to be a buyer at kind of what I call, a disaster level, someplace that I'll take the chance that if somebody actually sells it to me, I'm a willing buyer. And I had done some mathematical calculation and came up with something with the 88 range. So I've bought it there, and I'm certainly happy to see it at 110. The long-term prospects for Meta are, some people still love it and thinks that they're, the future. I'm personally not much of a believer of the metaverse unless you're, 20 years or younger. That doesn't mean you can't get a decent crowd of people. The youth across the globe may very much go for playing games and doing things in the metaverse, but I don't know. I'm in my 60s. To me, I don't see the appeal, but maybe it's just my age. I don't know. So I can't tell you I have a great long-term story for this or something I totally believe in, but down where it reached, I had a sense that I could kind of potentially scoop a bottom. And so far, it's working. If we got up to probably in here in the upper 140s, I'd probably kick it out. At that point, I've made 50% on the name. I have no idea if we're ever going to get back up into, the levels that we saw on the spike high this year back in March. So let's call it, 233. It happens to be where the 200-week moving average is now. Over time, obviously, it's not going to stay there. but you could look at that as being, kind of long-term equilibrium price right now. But, I put it on as a trade, and I'm hoping to still be able to get this north of 120 before I start thinking about kicking it out. Microsoft, another key name, came right to the 200-week moving average a few weeks after the downside exhaustion signal. Again, this downside exhaustion signal offsets the exhaustion signal to the upside that we essentially had just by the all-time high. So it is now stalled against its propulsion exhaustion level at 245. You'd have to have multiple Friday closes above that to think that it has a chance to get back up to 280 to 300. What you don't want to see are new closing lows for the year beneath the 200 week, because that opens up the door from somewhere near like the 210 level for it to come down to 200. It's only 5% lower, but that would be the initial test if we make new lows. Also look here for a possible W pattern in the MACD. It's still too early to tell, but potentially a double bottom. NVIDIA. So 9-13-9 pattern. So for those who know DeMarc's, this is a textbook DeMarc pattern. Sideways after the 9 count before a decent rally. 13 count got you a decent rally. 9 count getting you a rally. You're still in a downtrend. You've continually made lower lows this year. Let's see where the downtrend line is from the all-time high. So we're getting closer, and that's just kind of in the same neighborhood as the TDST line is going forward. So somewhere around 179, 180 level, you're going to have to deal with the downtrend line and potential resistance from the TDST line. And think of that in terms of, in a bigger picture, even if you break out here above this, you're still going to have potential resistance at 191. So you could and this is how like the media jumps on the stuff. Some technician's going to be on TV tell you this, if this happens, that it broke out to the upside, and all you may do is end up kind of stalling against these prior highs from early this year. So they'll tell you it's a breakout, and then you really have nowhere to go on the upside, and this stops at 191, 92, something like that. So maybe you get an inverted head and shoulders pattern, but you'd still need to make another shoulder down before that would be complete. So if you weren't a buyer in October near the lows, it's tougher to be a buyer now. At least you're on a 5 count up, so a 5 count towards a 9. So maybe we get a year-end rally, and this continues, to help form a bottom. But I'm already looking at what is a left shoulder and a head. Again, it doesn't mean it has to make another downside shoulder, but you would think that it would first need to rally, squeeze some shorts, and then come down and make one more right-handed inverted shoulder before it potentially has a bigger bottom in place. Tesla, been under real pressure recently. However, look what's going on this week. Let's blow this up. So we make new lows for the year. We're just above the 200-week moving average. You do have the downside exhaustion signal here on the 13. I am not a seller of Tesla. If anything, I start using any further weakness to be a buyer. Lots of ways to be a buyer. You can buy the stock. You can buy calls. You can buy a call spread. You could sell a put. You could sell a put spread. Lots of different ways to potentially take advantage of this decline if you're inclined to do so, but I would not be a seller now of the name because of what we're seeing here with the 13 count. Doesn't guarantee that it has to stall the move. Now, here's a 13 count back in August of last year that, it continued well past, but right here, right now, I'm not, you can see too that, let's look at, I'm kind of thinking, here's a level that seemed to have, some lows, and we are lower than that, and this could be a false breakdown. I don't know, but if I didn't have, unless you need a tax write-off and you want to take the sale on just a pure technical basis where this looks like a head and shoulders top, I'm not sure I want to go delve into this now, simply because of the 13 and the 200-week moving average. And being a name like Tesla, where Elon Musk has kind of culty followers, both individuals and professional money managers who think that the guy is a genius, they may come in right near this 200-week moving average and look at that as a welcome opportunity in order to be buying. So tough call here, but if anything, I'm more inclined to use a little further weakness to be a buyer than I am to be a seller. The one thing about being a seller is you at least know at current price. Anybody who has bought this in the last 2 years, so you look back to November or December of 2020, anybody who has bought since then is underwater, and that does put a significant overhead resistance here in place. But from a pure tactical point of view, it's pretty darn tough to be a seller when I'm staring at a 13 that's pretty much right on the comes at the same time you're hitting a 200-week moving average. And the last name we'll do is Taiwan Semi, TSM. This bounced on the 9 count in October. It has moved straight up since, stalling against the 200-week moving average. Same place it had bounced on previously, now stalling against. Even if it gets through, it's going to have some resistance here against the recent TDST line at 87.80 or so. You'd have to get through there and then run stops above in order to get to, what is that, 90, almost 97 here. That would be kind of a reasonable target. Downtrend line has, if we go to the all-time high here, any of these lines broke, and even the most recent high got broken 2 weeks ago. So there are no downtrends that really are in effect. I could go shorter term, and let's see, that probably is still good. Yeah. So if we take, the 2 recent highs of moves, we can still put a downtrend line, but nothing off of the higher levels is still a valid line. So all in all, look, we've gone through these big, pardon me, 8 names, my version of the current FANGs. And there's not a lot of clear-cut decisions here. A lot of these are mid-range. They've bounced off of the October low, but they're close to resistance or places where new positions at current prices aren't necessarily great risk-reward trades. And generally, if I don't have a good risk reward, I don't put the trade on. So that's it for this week. Again, have a wonderful holiday. I will see you again next week, and signing off. Bye-bye.